This is Chapter 12 in your Economic Development Finance, and we are going to discuss community-based financial institutions. Community-based financial institutions are organized around their ties to the community. Both are private sector institutions that are funded primarily from interest-bearing deposits. And the two types, the first is the Community Development Loan Fund, and these are unregulated. And the second is the Community Development Credit Union, and this is regulated. They both have the same goal. Their mission is to serve an underserved low-income community. And so we're going to go through each of these individually. The Community Development Loan Fund, again, this is unregulated. It is locally organized and controlled by nonprofit organizations. It does resemble a revolving loan fund, but these are not for profit, so they have access to charitable funds. It is best suited for short and medium term financing for real estate, cyclical working capital loans, and equipment financing. So because these are revolving loan funds essentially, you are repaying to the fund. Money must be repaid, so these are not grants. So they should invest in short and medium term projects. The way that they can expand is first off by servicing a larger geographic area or diversifying the borrower base. The second type is the Community Development Credit Union. This is a financial cooperative that provides banking services and loans to members with a common affiliation. So to qualify as a Community Development Credit Union, greater than 50% of members must have income below 80% of the national median household income. There are benefits to being a Community Development Credit Union. The first off is that once you have that designation, you do have the authority to accept non-member deposits. There are exceptions to aggregate limits on business loans, access to low interest loans and technical assistance from the National Credit Union Association's Community Development Revolving Loan Fund, and greater flexibility in defining the field of membership. So how would a Community Development Credit Union expand capital? First off, poor households are less likely to have banking relationships and often rely on cash checking companies and pawn shops. They expand capital because they serve different borrowers than commercial banks. They are providing these poor clients. They provide small amounts of money to entrepreneurs who have limited collateral. And they offer technical assistance. This technical assistance would be provided by a partner or a nonprofit organization. Community development credit unions are not very effective until they reach at least $5 million in assets. And the problem is that they rely on deposits to raise funds, but service low-income areas with little to save. So a solution would be that non-member financial institutions can make deposits, and they can accept deposits from social investors. So they are able to take non-member deposits.